All right, welcome once again to this revision class. We are here to revise financial accounting, and we are looking at this exam for October 2021. And we are looking at question 3 in particular, which is around the non-for-profit. Now, just like the way we have companies that are for profit preparing their financial statements, non-for-profit organizations also prepare their financial statements. Now, we have certain differences that are between for-profit and non-for-profit. Though they also they do prepare financial statements, and as we can see down here, we have an income and expenditure, which is basically what you would call as your profit and loss from the other side. And then we have the financial position. Now, apart from that, maybe just also to help you understand, non-for-profit usually also run a profit venture, especially for examination purposes. In most cases, non-for-profit will always have a profit venture. And why this profit venture is because these non-for-profit, they're basically sort of charity or associations. Now, the reason why they start some for-profit organizations or companies is to enable them to generate some amount of money that can help them sustain themselves. So sometimes they can choose to do a restaurant, they can choose to do a bar, they can choose to do whatever it is. Now, for example, this case, these guys did, I think, a coffee shop. So whatever they may choose to do is solely for the purpose of generating amount of money to cater for them. Now, given the dynamics of how a profit venture runs, we separate the operations of the profit venture from the non-for-profit. And that is why you see, even in this question, the examiner went ahead to first ask us to prepare the profit or loss for the coffee shop before we could actually do the income and expenditure for the club and then the financial position for the club. Now, the club owns the coffee shop, okay? The club owns the coffee shop. But at the end of the day, what happens is that we have to first prepare the P&L for the coffee shop. And what we get as profit or loss from the coffee shop goes to the income and expenditure as, of course, an income, or in most cases, basically an income. Okay, yeah. So this question we can try to go through. So they are saying the following information relates to Twegate Women's Social Club as at January 2020. So we have non-current assets. We have land. Land is a non-current asset. Then we have building. And then under here, they give us a cost of 180. As you can see, this building is now worth 125 million, okay? Is now worth 125 million. And then we have truck. The truck cost us 120 million, but its value is now 98. So the 125 and 98, these are like their carrying amounts, like the carrying amounts, the net book values of these assets at the start of the period before we can even depreciate them for this period. This is the carrying amount, like a balance brought down from the previous period. And then we also have what we call the current assets. And under current assets, we have now they are telling us we have ordinary subscriptions. Now, what happens with non-for-profit? We understand very well that non-for-profit usually have what we call members, and these members usually do subscribe. Now, we have two categories of subscription. We have what we call ordinary subscription, and also we have what we call life subscription, okay? Now, what happens is that the members contribute on a routine basis. It could be monthly basis or it could be annual basis. Now, when you come and they tell you that this is these are balances, this information relates to to a Gate club, and we are seeing ordinary subscription under assets, this means that these ordinary subscriptions are those that are outstanding for the period from the previous period, because ordinary subscription in themselves are incomes. Okay, it's basically one of the strongest source of income for a non-for-profit. But if we have some ordinary subscriptions that have not been paid, then those fall under the category of what we're trying to look at called, it's more of accrued income. Basically, the subscription relates to a financial period that has ended, but they are not settled. So they are assets, because we hope that in the future, the members will be able to pay these subscriptions. So that is why we have that there. And then we have the cash and bank, okay, which is 21,500. Now we have what we call prepaid utilities, okay? We have what we call prepaid utilities, which is 4,200. Now, just in the same way, of course, prepaid utilities, these could be utilities that relate to now this financial that we were paid in advance, okay? So that is very important for us. Then this cash and bank, maybe just to comment about cash and bank. Now, for non-for-profit, we have what we call the receipts and payments, okay? We have what we call the receipts and payments. Now, the receipts and payments account is very similar to what you may call the cash book in the non-for-profit. As you can see, it records receipts, basically money you have received, and then it records payments, basically money that you have paid out, okay? So that is why we have our receipts here, and then money we have paid out. Now, if they are telling us that up here we have cash and bank at the start, this 21,500, you'll actually come to realize that it is your balance brought down within here. So that's why you have balance brought down 21,500 in here. So it's basically your balance brought down. It's basically your cash book in this other side, okay? So that is very important. And then we have what we call the prepaid utilities, okay? That one I've already commented about it. So we have our total assets there. Then we have accumulated fund. Also to comment about accumulated fund is what you might call capital when it comes to the profit, for profit ventures. Accumulated fund is that capital, you get it. So here we have been given it to us. Sometimes the examiner doesn't give this figure and asks you to calculate it. And in calculating it, you draw up what we call the statement of affairs. Okay, now if you're listening through this or you're watching a replay, it's very important that when you're part of these sessions, you have somewhere to write. So some of the things that I comment on that seem to be unfamiliar to you, you're able to write them and look up to them later on, or ask around for notes that could incorporate this. So one of it is a statement of affairs. Sometimes the examiner may ask you to prepare a statement of affairs, which is more so like what we are seeing here. It's more so like a statement of financial position, but it basically looks at figures at the start of the financial period, okay? Just like the way we're having this information. This is like a statement of affairs, okay? So usually the statement of affairs is used to calculate the accumulated fund, okay? And we calculate it based on the principle of the accounting equation, which says that assets is equal to liabilities plus owner's equity. So in most cases, they will give you information relating to assets. They also give you information relating to liabilities, and all you have to do is get your total assets and subtract your liabilities to be able to get what you would call your accumulated fund, okay? Yeah, and then we have what we call the retained surplus. Now, in the same way, when it comes to non-for-profit, we basically don't have what you would call retained earnings, okay, or retained profits. Now, when a non-for-profit organization makes profit or okay, may not be called profit, but when its incomes exceed its expenditure, we call that a surplus, okay? And when the income is lower than the expenditure, then we get what we call a deficit, okay? So when they say retained surplus, means that these are this is an accumulation of different surpluses for the previous periods, okay? Just like the way you would have your retained earnings. And that is why you're seeing they are together with the accumulated fund, because together the accumulated fund and retained surplus would definitely form what we call our equity, okay? What would be our equity in this case. So that's very important for us. Then we come to non-current liabilities. So just like any other running entity, they have a bank loan, okay? So treated in the same way. Then we have what we call the life subscription. Like I said, we have two types of subscriptions. We have the ordinary subscription, and then we have the life subscription. Now, the life subscription is different from the ordinary subscription in one way. Life subscription is paid in advance and could relate for a period, let's say over 10 years, okay? So what that means that if it relates for a period, let's say 10 years, then you need to be able to see how much will relate to each year, okay? So we usually do an allocation that relates to each financial period, as we shall see as we proceed. So that is something for us to note. And then we have what we call, of course, the current liabilities. As you can see, we have the accrued general expenses. I think from the word accrued, you basically understand that these are general expenses that had not been settled by the close of last year, and now they are accrued, okay? We included them as part of our expenses, and that's why they came to our statement of financial position as liabilities, as we can see there. And then we have what we call the ordinary subscription, the ordinary subscriptions, and they are putting something in the liabilities. Now, in the same way, I think you saw we had some ordinary subscription in current assets, and then we also have some subscriptions in the current liabilities. Now, I want you to understand one thing. If you're part of an association, just like the way you're a student of, let's say, the Institute of Certified Public Accountants, there are students who have paid their subscriptions in advance, and there are also some students that have not paid by the end of the financial period. So these ordinary subscriptions that we have here are those that are outstanding, okay? These subscriptions we have here are for those people that didn't pay. So to us as an association, that is an asset, because those people have to pay us in this now financial year. Now, the only ordinary subscription that come here under liabilities are usually to these guys that pay in advance. The reason why we are calling them liabilities is because this money does not belong to us unless the financial period ends, okay? So that's why we call it ordinary subscription. So it's very important that you distinguish this and this, and it's not a mistake you seeing ordinary subscription here and seeing ordinary subscription here. It's because you have different categories of people, okay? Yeah, so that is very important. So given that in mind, we now have our total accumulated fund and the liabilities right there. And then we have our receipts and payments account for Twegate Women's Social Club for their end the 31st December 2020, as shown below, okay? So they are giving us, like I said, this receipts and payments is more like a cash book, okay? So they are giving us our balance brought down, which we also saw up there. We have ordinary subscription, life subscription. Now, whatever you're seeing here was actual money that was received, okay? It was actual money. These were receipts. And then what you're seeing here, these were the payments that were actually made in the period. Now, as a student of financial accounting right now, you distinguish between something that is paid and something that is an expense or is an income, okay? Remember, when we are recognizing income or expenses, we don't necessarily look at what has been paid or what has been received. We rather look at what has been incurred, in case for expenses, either paid or not paid. And then for income, we look at what has been earned, either has been received or not received, okay? So that is very important for you. So when you see ordinary subscription here of 105, this should not make you think that these were ordinary subscriptions for the year. This ordinary subscription that was received could relate partly even to the next financial year, okay? And then we have what we call, we have an additional information here. So they are telling us that at the beginning of 2020, the club decided to start a coffee shop business, okay? At the beginning of 2020, they started to start a coffee shop business. So the club organized a fundraising event with the aim of raising funds, okay? And then they are also telling us that the club's policy is to apportion general expenses, utilities, printing, stationery expenses between the club and coffee shop in the ratio of 4:1. And they also go ahead to tell us that the accounting policy of the club is to recognize life subscription over a period of 10 years. Opening life subscription has a remaining useful life of 5 years. Now, I want you to see something here. The reason why they have given us this policy is because when we are preparing this so-called profit and loss for the coffee shop, we only include the income for the coffee shop and only expenses for the coffee shop, okay? So we have to make sure that we understand that, and we are going to see when we are doing this question. Then they are also going ahead to give us the depreciation. So they are telling us that depreciation of non-current assets is as follows. They have told us that the building and the truck, all them, those depreciation is at cost, and they have given us the respective percentages. Then they go ahead to also tell us that the coffee shop purchases and sales were on credit basis. The club balances as at 31st December 2020 were indicated as below. Inventory, trade receivables, trade payables, prepaid utilities. These are the ones at the end of the financial period. Remember, they gave us what we had at the start of the financial period. Then we have outstanding general expenses. Then we have accrued ordinary subscription. And then we have what we call the prepaid ordinary subscription as well. I believe now you know what these words mean. Like we said, the word accrued, when it comes to income, these are subscriptions that you expect to receive, but people have not paid to you. So this is an asset in its own. Like one we saw up, the same thing also happens with the prepaid ordinary subscription. The 2,300, this will be a liability to you. When members pay in advance, means that you actually have to recognize this only when the period that they relates to is actually is done, okay? So they come right here and ask us to prepare Twegate Women's Social Club for the financial year ended 31st December, a statement of the profit and loss for the club, for the office or coffee shop, and then they also want something, the income and expenditure for the club, and then the financial position for the club as well, okay? So that is what we basically do have. So now, at least I've given you a highlight on how each of these play. So we are going to start with the first question, and I'm going to use my Excel as usual. So as we can see, they are telling us to start with the profit and loss for the coffee shop, okay? So what I'll come here, and they want us to, I'll say, Twegate coffee shop. It's important that if you're also following, you at least have a pen and paper so you easily follow through what I'm doing. Coffee shops, there's power when you write some things down rather than following when you're not writing. Twegate coffee shops, profit and loss as at, remember for the profit and loss account, we say for the period, it is the balance sheet that we, or statement of financial position that we say as at. So for the period ending 31st December 2020. Okay, so that is what we basically have as our heading. The headings are very important. Sometimes the examiners may, if you have very few marks, they may look out for some such elements to give you some marks. Okay, yeah. Now we know very well when we are preparing the P and L, okay, for any company, you know that we look at things like sales, okay? We look at things like sales, cost of sales, gross profit, then less operating expenses, and then we're able to get our net profit. Now, ours is to go back to the question here and see, do we have that information? All these things happen at the start of January. That's what we started with. So ideally, that was before we started the coffee shop. So these details in the receipts and payments are at the end of the year. So it includes part of what we have for the coffee shop. And then they also went ahead to give us some information here. Remember these balances that we have of inventory, trade receivables, trade payables, all those relate to the coffee shop, okay? Yeah. So, and then they're also telling us that the coffee shop purchases and sales were on credit, okay? Were on credit. Now, yours is to ask yourself also, do we have any, because even when you see here, we have cash, coffee shop, debtors, then we have donations, and then right here, administration costs, general expenses, utilities, wages of coffee shop attendants, payments to coffee shop, credit suppliers, printing and stationery, then we have audit fees, we have fundraising expenses, then we have motivational visits, then we have workshops and trainings, okay? And then our balance there. So one of the things that we need to find are our sales in total, okay? Because those sales have not been given. In the same way, we have not gotten the purchases directly. Remember, like I said, when we are doing our P and L, basically we have to start with our sales, sales revenue, okay, which we are going to look for. Of course, in case we had returns, then we'll definitely less sales returns, okay? But of course, if we don't have, let's say, returns, let me just put amounts here. So let's say we have an amount here, and I think we can use a degree of precision of 1,000, since that is what we are seeing in this question. So what I'll definitely do is I'll come here and include 1,000. So I'll create 3 columns. Okay. I'll create 3 columns there like that. So we have sales revenue, which we are going to look for. I just want to give you a small insight onto how our format will look like. Then we have less cost of sales. Okay. We have less cost of sales. And the cost of sales, we have opening stock. And then we have add purchases, okay? Now, purchases also could have some some adjustments to it, okay? Now, sales revenue, the only adjustment that is common, okay, and not even only for this question, is the sales returns, or what somebody would call the return inwards. In case you're given those, then you bring them, you write sales revenue, less return inwards, and then you're able to get your net sales. Now, the same thing with purchases here. Just in case purchases, we had what we call purchase returns, okay? Now, purchase returns are deducted, okay? Purchase returns are deducted because you have returned this thing back to the supplier. In case we had what we call carriage inwards, carriage inwards would also be added in this case. Now, I want you to also remember that we also have, just like we have carriage inwards, we have carriage outwards. Now, somebody would say if we put carriage inwards here, because carriage inwards is basically the logistical expenses that you incur in bringing these goods into your premises that you have bought. Now, we have what we call carriage outwards that we incur when we are delivering to our customers. Now, the carriage outwards are not basically recorded here, are not recorded under sales revenue or either added or whatever done. The carriage outwards are recorded under your operating expenses, okay? For them, they are recorded under operating expenses. They are not recorded, they are not an adjustment to sales revenue. Sales revenue, the only adjustment we have are returns inwards alone, okay? So that's very important, and not only for because this that I'm doing is for the general accounting. Either you're looking at the private sector or not, because even the coffee shop itself is a private business, okay? So I'm just trying to highlight these things because you need them and they're very important. And sometimes the examiner wants to test you from that, so they will bring such information and they want to see where you exactly put it, okay? Yeah. So that is what would have an adjustment here. And then in case we had them, then we would have our net purchases after we've made these adjustments. But since here we don't have them, I'll definitely leave them out, okay? And then after we've added our purchases, we now less what we call our closing stock, okay? We less our closing stock. And after that, then we're able to get our cost of sales that we are looking for. And the cost of sales adjusted, when you reduce the cost of sales from the sales revenue, you now come to your gross profit. You now come to your gross profit. I'm just giving you a journey ahead of us so we know what information to basically look out for. So after getting your gross profit, you now come to less operating expenses, okay? So that is basically our journey that we are going to look at. Now, given this, ours is to go and look for information from what we have been given that can actually be fed in this area, okay? Ours is to look out for information that we have been given that can fit in this area. So when we come back to our question here, I want you to look critically, okay? Like I said, this balance sheet, the one we are starting with, this will not be important to us for now because it was before the coffee shop came into presence. So our eyes are going to first look at here, okay? And we first want to get our sales and our purchases. Now, the examiner usually wants to hide these figures and wants you to calculate them, okay? Now, those that have been part of the journey before, or you have received the video for what we call the control accounts, you might have gone through something like this. So we are going to use the information provided to us to be able to calculate our purchases and our sales, okay? Now, to do that, we are going to use two accounts, okay? We have what we call it the purchases ledger control account. Okay, we have this, or you'd call it other than this purchases ledger control account, it can also be called the accounts payable Control accounts is a topic on its own that you can be able to find within our videos. So we have this, and then similar to what we have for sales, okay, we have what we call the sales ledger control account, and then we have what we call the accounts receivable. We have what we call the accounts receivable control account. Okay. Now, I'm going to show you how these things are very important in this question, and examiners usually want to bring the questions in this case, because for you to calculate, it's not just a direct thing that you just get the figures and put them there. Okay. But like we believe everything can be learned. Okay. It's just a matter of putting the mind there and also being able to be interested, okay, in some of these things. So let me just try to draw this as well. Okay. Okay. So I have my debit here and I'll have my credit, okay? Now, not to confuse you much, let me remove these headings. And we call it accounts payable control account, and we call it accounts receivable control account. Okay. Yeah. So that's what we are going to call it. Now back to our question, and you're going to see how we are going to play with those respective accounts. Like I said, we shall not look so much this side, because the coffee shop was not available and we are looking for purchases for the coffee shop. So, and they have given us what we call, now, how we fill our control accounts is we write our balance brought down. Now, accounts payable control account has, just like accounts payable, these two accounts work like just the way the normal accounts. Accounts payable are your creditors, and creditors are liabilities. Now, any balance brought down for such an account, okay, at the start of the period, let's say 1st January, is supposed to be credited. And then the balance carried down is supposed to be credited. Okay. This is December. We just use that. So 31st December, you're supposed to debit, sorry. As you credit your balance brought down, this is balance carried down, sorry, it's carried down. Okay. So as you credit your balance brought down, you come and credit your balance carried down. That is the principle that works. What happens with the accounts receivable is the reverse way, because the accounts receivable, they are assets. Okay. These are people you've sold to on credit that are yet to pay you. So for them, what we shall basically have is 1st January, let's say 2020. I'll just also leave that. Okay, that's brought itself. So balance brought down is on this side, and then balance carried down is on this side. So 31st December, maybe 2020. Just check this, because the financial we are working in is 2020. We shall have our balance carried down. Yeah, I want you to be very attentive because this information is very important. You may use it in different aspects. So since the coffee shop was just starting, because they told us here that the coffee shop started at the beginning of 2020. So we basically don't have a beginning figure for accounts receivable and a beginning figure for accounts payable, because we just started that at the financial, everything was zero. Okay. So when you look at what we have here, this is zero. And also what we have here is also zero. Okay. Now, if that is the perspective, yours is to come back and check here and see. So what were the closing figures? They have given us 12,300 for trade receivables and 4,400 for this. So I'll record the first one, 12,300. So what I'll come here on my accounts receivable. Remember, my balance carried down at the end of the period is 12,300. What I'll just do is I'll just put a degree of precision there, and I'll come on top here and put their thousands. It's basically in shillings over thousands. Very important to show the examiner that this has extra 3 zeros. So I'll do the same thing also for the other, for the 4,400. I'll come here, 4,400, 4,400. So that's what I'll do. I record it there like that. Okay. So I have recorded these closing balances. Now, again, I want you to watch something small. When we are looking at these control accounts, after we have written the balances, the balance brought down and the balance carried down, okay? We now go ahead to look at the detailed information that we have. Now, anything that increases our accounts payable balance is recorded here. And what increases our accounts payable are things like more purchases on credit, okay? So credit purchases increase our accounts payable, the people that demand us, okay? So we have to look out for credit purchases and put them in here, okay? Now, what reduces our accounts payable are payments to suppliers. When you pay to suppliers, when you pay to your suppliers, your accounts payable reduces. I hope you get the principle, okay? Because this is how this account works. Now, if it was for accounts receivable, the control account, the same way accounts receivable account works. Now, when our customers pay us, okay, which you would call receipts from customers, it reduces the value that we have within our accounts receivable control account. What increases our accounts receivable control account are extra credit sales. Extra credit sales, okay? So you need to be able to know these two things. Like the one we had here, these are credit purchases. When we purchase more on credit, it increases our balance on the side of creditors. When we pay our suppliers, it reduces. The same thing that also happens with accounts receivable. When we receive money from our customers, of course, the balance are reduced that we have to receive from them. And when we sell more on credit, our balance goes again up, okay? So that is the principle. So with that in mind, I'm now just going to look and see. Remember, I've not been given the purchases and sales, and they have told me that they are all on credit. So it's basically the reason why I've drawn up those two accounts is basically to look for the credit purchases and the credit sales. So basically, I don't have this figure, is what I'm looking for. and I also don't have this figure. But I should look for this figure and also look for this figure. And how am I going to get it? Is I'm going to go back to my question app. Here, there is no information that I can use that will help me derive those. So the information I'm going to use is within the receipts and payments, okay? So main is to look out for and see receipts from customers, okay? Now, you see here, you're telling me balance brought down, ordinary subscriptions, live subscriptions. All this does not affect the coffee shop. Now, what I only need from here is the cash, which they are saying is the coffee shop debtors. So this 56,500 is the money that was paid by the coffee shop debtors, okay? So this 56,500 is what I'm going to take to my accounts receivable as receipts from customers. Debtors are also your accounts receivable. Debtors are also people that you sold to on credit that are yet to pay you. So I'll pick 56,500 and bring it to here. So accounts receivable, receipts from customers, I record 56,400, okay? That is what I'll basically record. Is it, no, it's 56,500. It's 56,500. Yeah, so basically that is what we have, 56,500. And then what else we also have is when it comes to this other side, let me also look out for something that relates to payments to suppliers. So we have administration costs, which I'll first leave for now, general expenses, utilities, wages of coffee shop, not applicable. We have this line, which is payments to coffee shop credit suppliers. Payments to coffee shop credit suppliers. And it is worth how much? 15,400. When I look at the rest of the things, I don't see anything that relates to creditors or our accounts payable. Now, like the same thing, creditors are like your accounts payables. So I'll pick 15,400 and take it the other side. So 15,400, come and put it here as a payment to suppliers. 15,400, okay? Now, as you can see, that is all that we have that relates to those two accounts, okay? There is no any other information. So what we shall basically do is I'll now come back to here. I know I've put different spaces, but you're not penalized anything. You can just bring your pen and circle here so that you just close it off. Now, ideally, the principle is this account has to balance, okay? This account has to balance, and that is the reason of the control account. Now, as you can see, this side we have a total of 19,800, and this side we don't have anything. So basically, the balancing figure, because if you add these two values, when you add these two values, you come to 19,800, and this side has a 0. Now, the balancing figure, since we already have this balance brought down, which was 0, the balancing figure here is actually the credit purchases. So your credit purchases are actually 19,800. Okay? That is what you have as your credit purchases. So that is what we have. Now you're going to see the same thing that we are going to do with when it comes to our accounts receivable. The same thing. When you look here, you see that we don't basically have we don't have anything this side, but we have a total of 68,800, which if I'm to add this up, this would get me 16,800. Now this 16,800 is actually my credit sales. Okay, so it means that ideally I'll have a similar what? A similar total now, okay, of 16,800 here, 16,800 800. I know it confuses if you're doing this for the very first time, but I want you to re-look at this critically and see how you can conceptualize it. Maybe I'll try to reduce the spaces I have put here to help you summarize this a little. But the reason why I leave all these spaces is you might have more items to feed in there that might affect this account. Items like returns, in case we had returns, we'll definitely bring them here. Things like, let's say, discounts, okay? Bad debts receivable, like bad debts for receivables would also come here, and so on, okay? But I would encourage you to watch the video for control accounts, maybe after this lesson, so that you understand how control accounts work, okay? In case you don't have that, you're able to reach out, and I'm able to give you that recording, okay? So this is the trick that the examiner wanted to basically give. But let me just try to give you an insight, and you're going to see that it would be actually the same thing. Now, if the examiner says that all the coffee shop purchases and sales were all on credit, now here is the point. If they were all on the credit, in the receipts and payments, they are telling us that we had received cash of 56,500. Okay, if we received cash of 56,500, remember we did start with the any data, so this 56,500 related to what we sold within the period. So 56,500 plus, if you come to down here, they come and tell you that the trade receivables that we remained with were 12,300. Ideally, if you are looking to understand how much sales you made in the period, it will be definitely the other guys that paid you that we just saw up, and these guys that you demand, which is basically a summation of 12,300 and what? And then the 56,500, the guys that paid you, okay, already. And that is ideally what we have done in these control accounts. We've been basically been able to add the 56,500 and the 12,300, and this has given us our credit sales. So even from the simplistic thinking, you can be able to get these values, but the examiner expected you to apply some control accounts principle, and this would yield you some marks, okay? So after I've gotten these respective figures that I needed, I'll just now get my credit purchases there. And since it's the only purchases that we have, and I'll come and put them here, okay? My credit purchases. And then I'll also get my credit sales that I got, which is 68,800, and also bring it here. Since I first have to adjust the cost of sales, so I'll basically put what? Put my sales in that column there. So that is what I'll basically have. So I have my sales, less cost of sales. Now opening inventory, I basically don't have opening inventory. Why? Because this coffee shop was just starting this financial year. All that I have is closing inventory at the end of the financial, which is 31st December 2020, which is 5,600. So I'll just come here, 5,600. I'll put it under my closing stock, 5,600. So this is 0. This I'll call it 0. Yeah. Now, in case I had been given information and this coffee shop existed at the start, I'll definitely have that information within my what? Within my balance sheet or statement of affair that I started with, okay? But even as you can look through here, there's nothing like inventory. So inventory will only have the closing balance, okay? So that is very important for you along this journey, that you understand how to basically play with that. So given that background, and we don't have any other adjustments onto our cost of sales, we'll definitely be able to get it. So we have purchases. Now we are going to less the 5,600, which will give us our cost of sales, which is 19 minus 5,600, which gives us 14,200. And if I'm to get my gross profit here, I just want to use this column. Gross profit will now be 68 minus the cost of sales, which is 54,600. Okay, it will give me that. So once I come back here, mine is just to look through and see that I've been able to capture that. Okay, so the next thing that I'm going to look at is my expenses, since I've gotten my gross profit. Now, like I said, when it comes to a nanny for profit,